Okay, let's dive into this. It's late, the markets are closed, and as we sit back and look over the data from the past week, we really need to take a breath. We need to reflect on what's actually happening beneath the surface. Earnings season is kicking off, and AI companies are starting to hand in their report cards. But I don't want us to just read the headlines tonight in this explainer. I want us to look at the psychological undercurrent of this market. We're going to sift through the noise, examine exactly how capital is choosing its winners right now, and understand the deep, structural shifts in this AI revolution. If you just glanced at your screen over the last few days, you might have easily fallen for an illusion. Tech stocks seem to be repairing themselves, SK Hynix had a massive debut, and there's this palpable sigh of relief in the air. People are whispering, asking if AI's easy mode is suddenly back. Are we returning to that phase where you could throw a dart at a board of semiconductor tickers and make a profit? I am highly skeptical. When you hear that kind of collective relief, it usually masks a hidden stress. We need to ask ourselves if the easy money has truly returned, or if we are just looking at a very well-lit mirage. To be honest, when you look beneath the hood, the reality is starkly different from those optimistic headlines. The market isn't rising together. You have the S&P 500 up roughly 1.2% and the Nasdaq up 1.7%, but then you look at the Dow, down 0.5%, and the Russell 2000, representing small caps, dropping 0.6%. What is the common investor actually panicking about here? It's the sheer anxiety of holding a diversified portfolio and watching it bleed out, while a handful of large-cap tech and AI-related assets completely dominate the indices. Small caps are just being left out in the cold. What this tells us is that market breadth is a very real issue. Yes, things improved slightly by Friday, showing it wasn't exclusively a few megaweights pulling the card, but the underlying truth is crystal clear. Capital is becoming ruthlessly picky. It is strictly selecting very specific AI winners. We are not in an environment where a rising tide lifts all boats. Capital preference is incredibly tight. Investors aren't buying the whole sector. They are hunting for the absolute safest, most dominant players because, frankly, they're terrified of being caught in the wrong subsector when the music stops. And speaking of specific winners, we have to talk about SK Hynix. My first reaction to this was just looking at the sheer scale of it. A $26.5 billion ADR IPO financing in the US market with a first-day pop of about 14%. It's a massive number. It tells us that global funds are still more than willing to pay a heavy premium for AI memory. They are desperately trying to anchor their portfolios to the physical building blocks of artificial intelligence. But let's not just share the headline. We absolutely have to inject some healthy skepticism here. With the $26.5 billion vacuum cleaner turning on in the market, we have to ask, is this new anchor actually expanding the overall pie for the memory sector? Or is it just cannibalizing liquidity? Is it stealing capital away from Micron, from standard DRAM, or draining liquidity from the broader Korean market? The hidden stress here for traders is whether they just bought into a crowded trade that's merely shuffling existing chips around the table, rather than bringing new money into the casino. We really have to wait and see how the subsequent trading sessions validate this.
Section 1. Beyond the hype. Meta and unit costs.
Let's shift our focus down to the corporate infrastructure level. A very quiet but critical storyline is developing around Meta. They're planning to start producing their self-developed AI chip, Iris, this coming September. This isn't just a tech update, this is a fundamental shift in corporate anxiety. A year ago, the market rewarded companies just for hoarding GPUs. Now, the honeymoon is over. Meta's move is driven by a profound need to lower external GPU reliance and aggressively control infrastructure costs. Investors are waking up. They're demanding to know if these massive AI capital expenditures can actually lower unit costs, generate tangible revenue, and improve real cash flow. The days of blind hype are fading. The era of demanding a real return on investment has arrived. Section 2, the core focus, the AI electricity revolution. You know, the more I look at the data and corporate behavior, the more I realize that AI is not just a standard software upgrade cycle. We're looking at something much closer to the industrial electricity revolution that happened a century ago. Think back to when factories first adopted electricity. At first, they just took out the central steam engine and dropped in a massive electric motor. They didn't change the layout of the factory, they didn't change the workflows. And you know what happened? Productivity barely budged. Swapping the power source without changing the system yields very limited gains. And that is exactly where we are with AI right now. Companies are just plugging AI into their existing, outdated workflows and wondering why their margins haven't magically doubled. And this brilliantly illustrates the evolutionary stages we have to endure. Real productivity leaps take time. First, you have the single tool replacement. That's the swapping the motor phase we are in right now. Next comes process restructuring, where you actually redesign the assembly line around the new technology. Finally, you reach organizational restructuring, where the entire company is built natively around AI. Real explosive productivity, the kind that actually justifies these massive valuations, only emerges at step 3. Recognizing this essential process helps calm the anxiety of, why isn't this changing the world today? It's a structural evolution, not an overnight miracle. Section 3. The psychological reality. Hidden liquidity anxiety. I want to pivot to the micro-level reality of managing money. I want to share a personal portfolio decision from this past week. And please, absolutely do not take this as a signal to buy or sell anything. This is purely a case study in trader anxiety and risk exposure. I added an Intel reversal validation position to my account. This action wasn't just about averaging down or making a blind bet. It was about continuously validating the reversal logic heading into earnings. But here is the critical part. The stock itself isn't the story. The real story is the portfolio stress that this action created. By making that move, my exposure to the memory and semiconductor sector became heavily clustered. The risk profile of the entire portfolio shifted dramatically in an instant. And the immediate result of that action was my cash position dropping to roughly 9.3%. Let's pause and think about what this really means for an ordinary person sitting at their desk. A 9.3% cash level induces a very specific kind of psychological dread. It's the feeling of having almost all your chips on the table when you know the macroeconomic winds are shifting. It's not just numbers on a screen, it's the weight in your stomach knowing your buffer is incredibly thin. So the true problem exposed this week wasn't whether buying that specific stock was right or wrong. The real terror of investing is about optionality. Ask yourself, after every move you make in this market, how many choices do you have left? When your cash is depleted, you lose your flexibility. You become a passenger to market volatility rather than an active participant. The hidden anxiety is losing the ability to react when the data inevitably surprises us. Section 4, Preparing the 3 scripts. Let's see how this builds into our strategy for the days ahead. We are walking into a dual gauntlet of macroeconomic data and crucial corporate earnings. Just think about this timeline. It's a minefield. July 14th hits us with CPI inflation data and the start of large bank earnings. The very next day, July 15th, we get ASML, a bellwether for global semiconductor equipment. And then July 16th, the TSMC earnings call, the absolute core of the AI hardware supply chain. It's enough to make any trader sweat. But we aren't going to try to wildly predict these outcomes. The market is way too complex for that. Instead, we map out the conditions to preserve our psychological capital. We prepare 3 scripts. Script 1, if inflation is mild and semiconductor guidance is strong, we hold steady and carefully observe if AI orders are actually translating to the bottom line. Script 2, if the data is neutral, we have to emotionally accept market rotation. Money will slosh around and we shouldn't let our egos overreact. Script 3, if inflation runs hot, oil spikes, or semi-guidance is weak, we prioritize flexibility above all else. We manage our cash, we cut our weak positions, and we put portfolio elasticity first. We don't predict the weather, we just build a solid ship. So the crucial point is this profound, introspective golden rule from our notes today. It summarizes it perfectly. Reviews aren't for predicting the next week, but for deciding what must appear before I act. When we sit down at night to look at the data, we aren't crystal ball gazing. We're setting psychological tripwires. We are deciding in a moment of calm exactly what conditions need to materialize before we allow ourselves to pull the trigger in a moment of market chaos. I'll leave you with this to reflect on tonight. When you look at your portfolio tomorrow morning, ask yourself honestly, are you exhausting yourself trying to predict the unpredictable? Or are you calmly preparing your conditions for action? The market is going to do what it wants. Our only true edge is our discipline and our psychological readiness. Think about it. Good night, and we'll see you next time on This Explainer.